Welcome back to a new Money discussing investments evening. My guest, Henry Biddlecombe. If you'd like to email me, my details will appear on the screen. Henry, before we go, I've got one question to ask you. You know, the two-pot system in South Africa, which just to remind people, is where individuals can actually take money from their pension funds, not only on withdrawal, death or retirement, but actually draw. The first lot was on monies as at the 31st of August. You could draw up to 10% of your fund that you'd accumulated over the years with a maximum of 30,000. Going forward, contributions after the 1st September will allow 2/3 to go into the retirement fund, 1/3 to go into the savings pot, and every year, as long as it's more than 2,000 Rand, you can draw the funds out. I'm not going to talk about the merits and the demerits of a drawing from your pension fund. It will have an impact. But my question to you, Henry, is the only people, 47 billion has been withdrawn. And of that, about 8 billion paid in tax. That's a coup for SARS. And the only people who can draw from retirement funds are people who are working. These are individuals who can put bread on the table and feed their families, and they are short. So my question to you, with that amount of money being needed from individuals who are working, do you think our interest rates shouldn't drop a bit further? I mean, we've reduced interest rates by 0.25% 3 times. Are we not just really, I mean, we've got petrol price increases, we've got electricity increasing, so whatever you may be earning more, you're going to pay for those goods. And the debt that people have in this country, I mean, today, R1 million debt, which covering a motor car or a bond on a home, is not enormous. It's a need to have, maybe not nice to have. But what is your view about our governors and the Reserve Bank's role in terms of reducing interest rates?
Yeah, look, I mean, obviously, we were hopeful that we'd see more cuts last year, although given the inflationary outlook in the States, it seems like the scope to cut rates going forward is a lot, it's been reduced a lot. So kind of disappointing for the consumer, I guess. But remember, the Reserve Bank's got a tightrope to walk, where, you know, we've got a weak currency at the moment. We are a net importing nation. We import a lot of inflation. And so they have to protect the rand. And to protect the rand, they have to keep rates higher for longer. Otherwise, we import even more inflation. It's also difficult to raise rates after you've cut them. You know, you don't want to have to go through that, especially not at this stage of the cycle. So I think they're cutting conservatively. Could they cut a little bit more? Maybe. But is it obvious? No. So I think they're just being conservative. Are they wrong to be conservative? No.
Okay, well, we'll agree to disagree on that one. I see the consumers, I see them, I hear from them on radio, on TV all the time how they struggle, and the two-pot system is an absolute proof of how many people... Yeah,
but remember, that's also a function of economic growth. Eh? Yeah. So there are two ways you can address that problem. One is through cutting rates, perhaps at the expense of inflation. The other solution is to grow the economy.
Well, you're absolutely right. I mean, both are important, growing the country.
Yeah.
But let's just go to my first email. It's Lewis in Hyde Park. He says, could you help me understand long-standing debate between quality and quantity investing? The recent surge in certain stocks has left my portfolio highly unbalanced. And you know, that's quite right, Henry. If you look at people who've had portfolios, global portfolios, and even South African portfolios, what's happened, you've had a lot of run in some of the, in a few companies which have unbalanced portfolios. So your view on quality versus quantity?
Yeah, I'm not sure what he means by quantity investing, but I'm going to assume...
Let's talk about...
Yes, I'm going to assume he means quantitative.
Quantitative.
So quality, yeah. So qualitative investing quality investing at least is a kind of fundamental investing, where you invest in companies that earn a very high return on invested capital. And while those stocks are often expensive, they stay expensive and they tend to outperform through time. Stocks like Coca-Cola is a great example. Quantitative investing is where you don't pay much attention to fundamentals, things like return on invested capital or PE ratios, payout ratios, and that kind of thing. And you really look at price movements and momentum and technical levels, you know, resistance and support levels, etc. And that kind of investing is more short-term in nature. It's more systematic. Often it's driven by algorithms. And often it's a good complementary strategy to a fundamental one. So perhaps it's a good idea. It often is to invest in a long-term fundamental approach, but then also to invest in a shorter-term quantitative approach, something like a hedge fund.
Yeah, Henry, very difficult because markets are driven, as you know, by fundamentals. But at the moment, it's the news of the world, the sentiment that on a daily basis. And we always used to see, I mean, weeks went by. Now we get news every single day. I mean, by the time you and I come off the air, you'll be back onto you having a look at what's happened in the last 40 minutes. But that Philip in Newland says, every business conducts a basic SWOT analysis. For those of you who don't know SWOT, it's the strength of your business, the weakness, the opportunities and threats. Yet these large companies seem never consider the threat of lower cost chip development. How will this impact in the future of AI companies? You would have thought that all these companies would have said, what are the threats to our business? And one of the threats had to be chips at a lower price.
Yeah, so I actually think the viewer might be asking about the future from now. So if you look at a company like NVIDIA, which has got to be the large business he's talking about, they've created tremendous value by selling GPUs at astronomical gross margins. You know, they make a gross profit of around 80% on a GPU. And every quarter, they're growing their revenues at like 50% year on year. So the incentive to compete those margins away is tremendous. And I think that's ultimately what will happen. Is that a threat to NVIDIA? Yes. Is that a threat to the market because NVIDIA is 6% of the S&P 500? Yes. So I'd be underweight NVIDIA. And I think cheaper AI chips are certainly a threat to that part of the market. That's not to say that AI is a threat to the rest of the market. I think AI is a great thing, and it stands to make business and people a lot more productive.
Henry, when you talk about NVIDIA being underweight, let's talk about two things. Someone who doesn't hold NVIDIA or any of those type of stocks, and someone who's now overweight NVIDIA because obviously in terms of the performance in 2024, it actually skewed their portfolio. And I always say to people, the way to sell shares is, and the way to sell, if you've got a portfolio and let's say your strategy is 60% equities and 40% others, and your strategy goes up to 70% equities, that's the time when you've got to say, I've lightened, get back to my norm of 60-40. But because it's always so hard. And then you've got to look at the different stocks, which stocks now have run higher and which are now 10, 15, in some cases 20% of your portfolio. So my question to you is, if you don't have NVIDIA or similar stocks, would you buy? And if you overweight NVIDIA at this price, would you sell?
Yeah, I wouldn't be chasing NVIDIA here.
Yeah.
And if I was overweight NVIDIA, I'd certainly be taking profits. You know, it's a great lesson in the importance of having a diversified portfolio. If you had no exposure to NVIDIA, it's been a costly exercise. I mean, remember when that thing was less than 0.5% of the S&P 500? Now it's the biggest stock in the S&P 500. So if you didn't own it, it's cost you huge relative performance. But given where the valuation is now, given where we are in the cycle, yeah, I think I'd be taking profits.
Okay. Then Yvonne in Plettenberg says, I recall you mentioning that you attended an event with Nikki Bush last year. Could you provide a summary of who she is and the value she brought to the event?
Yeah, so Nikki Bush is an amazing woman. I attended one of her talks last year at the Wanderers. And long story short, her family a couple of years ago suffered a terrible tragedy where robbers broke into their home and shot her husband dead. And that forced her to confront a life-changing event for which, you know, she says she was underprepared. And so now she uses it as a very powerful story to try and convince people that you care about to prepare for the unexpected or to prepare for the worst, not because it will happen, but just in case it does. And she also talks you through dealing with, you know, terrible scenarios like that. She talks about resilience. She talks about how when something terrible happens that you think you can't get through, you actually can. And it's just a wonderful story of resilience and a lesson in preparedness. So anyone who has the opportunity to attend one of her talks, I'd highly recommend it.
And I think you've invited her to a talk, Henry.
That's right. So she'll be talking to our clients to advise them on how to prepare for the unexpected from a financial planning perspective, but also from a philosophical and life and family perspective.
Okay, let me sneak one more email. Patricia Hillcrest says, are changes in bond yields solely driven by interest rate improvements? Also, what are your thoughts on investing in a 5-year government retail bond offering a 10% interest rate if I'm not subject to tax? I think that's a great investment. I think locking some money up for 5 years at 10% can't go wrong. You agree, Henry?
Yeah, I think it's come up a lot on the show. I think a lot of people are noticing, hey, bonds are looking pretty attractive, especially after we've done pretty well in the share market. And I think it's a great place to park some money while you wait for better opportunities.
Well, my advice to investors is to avoid checking their portfolios too frequently. In the long run, markets are driven by fundamentals and the performance of individual companies. I often say that on a daily, weekly, market trends are influenced by the news of the day. However, with Trump, even headlines could have a major impact on a daily basis. Focus on your investment strategy. Are you seeking income, growth, or a combination of both? Assets, your goals, rather than fixating on the short-term fluctuations in your portfolio capital value. You'll sleep a lot better. Henry, thank you for joining me this evening. It's important to note our program is to provide information and should not be construed as advice. Next week's program, we'll be dealing with healthcare again, and if you need to get hold of me, my details will appear on the screen. I'd like to thank you for watching, and good night.